Buenas tardes. De parte de Mercado Valores, su gestor patrimonial de confianza, les damos la cordial bienvenida. Soy Ronald Sánchez, asesor patrimonial de Mercado Valores. Tengo el placer de acompañarlos en otro espacio de jornada patrimonial Visión 360. Espacios que hemos preparado exclusivamente para ustedes. En esta cápsula revisaremos las perspectivas del mercado de renta variable al cierre 2022 y lo que nos espera para el 2023. Nuestra labor como asesores patrimoniales de confianza es ofrecerles un contenido de valor y de calidad que le permita analizar los escenarios para tomar las mejores decisiones. Por este motivo nos complace compartirles información de gran valor ante el contexto que atraviesan los mercados. Y para esto, hoy nos acompaña el señor Christopher Marx, Global Head of Equity Business Development de la casa administradora de fondos de inversión Alliance Bernstein. El señor Marx cuenta con más de 20 años de experiencia en el mercado de capitales. Previo a su posición actual se desempeñó como consultor, analista de investigación, estratega de inversiones y portafolio manager. El señor Marx es economista de Harvard University y posee un MBA de Stanford University. A continuación, el señor Marx realizará un análisis sobre lo que nos espera para los mercados de renta variable para lo que queda del año y el 2023 y nos brindará una opción de inversión que responda al concepto volátil actual. Bienvenido, Christopher. Es un gusto tenerlo con nosotros compartiendo su conocimiento en este espacio exclusivo para nuestros clientes. Good afternoon, Chris.
Thanks very much. I appreciate it. Today we're going to talk a little bit about what has been obviously a volatile and disappointing year in the equity markets, one that people have witnessed strong down market movements, and we'll talk a little bit about what's behind some of those, what investors are facing, the risks that they're facing, and we'll talk a bit about the portfolio that we manage and how we are addressing those risks. So if we first start off with what really people are facing, it's a combination of three intersecting risks that are driving some of the uncertainty in the capital markets. The first is the idea that growth is slowing. We are seeing slowdown in economic growth around the world, here in the United States as well as elsewhere. This is occurring against a backdrop of monetary policy and rising interest rates, which are bringing down valuations in a number of sectors of the economy, frankly, that had become overvalued over the last few years. And the root of most of this activity and what's at the cause of it is the rising inflation that we're seeing. So the combination of supply chain disruption and stimulus, which was put in response to the COVID crisis, has really driven a much higher inflation than people had anticipated. The reason this is a problem is that the way you cure that inflation is by pushing up interest rates. That tends to push you into a recession. That's been the historical pattern. And that's why people are concerned about these three issues. So if we take a look at these three risks and address them, we can talk then about what's behind them and what we think will be a well-positioned portfolio to respond to these types of risks. Recession is at the center of this. This is what people are worried about. There's lots of debate about whether we are technically in a recession here in the United States or elsewhere, and I think that debate is somewhat meaningless. We are feeling a slowdown, that's for sure. And there are cases here to some data that's quite disturbing and worrying, and I think most of the forward economic indicators, like the ISM new orders here you see, very weak, indicating that there's slowdown ahead. And you see it in the fixed income markets as well, where the yield curve has inverted, which has traditionally been a sign that recession is upon us. And you also see it obviously in consumer sentiment, which has really fallen quite sharply over the last few quarters as people have faced this. So people are concerned, corporate managers are concerned, the bond market is concerned. These are all showing you signs that people are worried that we have a recession upon us. However, there are a lot of positive signs still in the economy, and this is why we haven't seen a really sharp slowdown in growth. We have high household savings. Investors, or I should say individuals, during the COVID crisis through changes in behavior as well as stimulus money that was given to consumers, have really pushed their savings levels much higher. And here in the United States, we've seen that reflected in very high household savings. We also see that the flip side of that, savings is lower debt levels, and in particular lower debt service. The fees or the amount of money it takes to cover your debt payments as a percent of your income, that's quite low now. Now that's a combination of both that savings as well as still very low interest rates by any historical standard. And finally, we are seeing wages, at least for the time being, still outstrip that inflation. Now, you're starting to see in the most recent few quarters that relationship reverse itself and seeing real wage compression, and that's problematic for both consumption reasons, but it's also indicative that there will be more pressure for wages to go up in order to meet this inflation. And that's really what's on people's mind, is that inflation story. How will the markets respond to that? What can be done about that inflationary environment? Now, the sources of this inflation are many in form. I mentioned before, obviously, the supply chain disruption that we've been through. That has held back supply at the same time when government spending and help for consumers as well as low interest rates spurred a higher demand. So you didn't have to take a lot of economics to know that if you constrict supply and push up demand, you're going to push prices higher, and that's exactly the situation we're in today. So the question is, how can equities do in that environment, and what should we expect going forward? And if we see inflation in a normal range, 2 to 4, historically, that's not been a real problem for equities. They do fine in that kind of environment. The really low inflation is not good because that's typically associated with periods of economic weakness. That's what tends to come along with it, that super low inflation. And then periods of higher inflation, while the equity markets have positive nominal returns, on a real basis, you can tell that if you're over 4 in inflation and getting only 4 on your equity markets, you're not making real return. And so once inflation settles in above 4, that's typically not good for equity markets. And that's really the question that faces everybody, not necessarily where is inflation just now, but where will it settle in the long term. And I think there is a legitimate case to be made that inflation will be higher in the long term due to some structural forces that go well beyond the supply-demand imbalance we're seeing today. Notably, you have a number of demographic issues with baby boomers in large parts of the developed world retiring and moving from productive activity to just consumption. That's inflationary. You have an overall move against globalization, and this has been going for a while, but it continues apace. Not necessarily that we're going back to being completely separate economies around the world, but the globalization trend we've had for the better part of 20 or 30 years has been extraordinarily deflationary, helping to cap any inflationary pressures. And we're just going to see less of that going forward as more and more countries begin to pull back more supply onshore, hold higher levels of inventory, et cetera. And in the higher geopolitical risk that I alluded to earlier, that's causing some shift in behavior as well. And then finally, as we move towards a more environmentally friendly energy production and economy, that move towards that new set of resources is going to be inflationary as well, as we have to replace old capacity, add new capacity, and much of that is not as inexpensive. So these forces all argue that we're likely to see inflation at a higher level than we saw over the last 10 years or so. That 2% we all got comfortable with in the developed markets probably is a little higher going forward. Now, the other side of this inflation issue that I think is important is the profitability of companies. There is room to move, but corporate profits are globally at really all-time highs, and enormous degree of profitability that's held up in margins, or shows up in margins here on the right-hand chart. We have to worry about how much that can come down, and it argues for selectivity, being careful, choosing companies who can maintain those high profit margins in the light of higher prices on inputs or labor. And so it's really going to benefit, in our belief, companies with good competitive advantage, high quality business models that can offset some of that pressure. So you're faced with an equity market that feels a little scary, that is faced with economic weakness, inflation pressures, volatility higher, seemingly a lot of geopolitical uncertainty with war in Ukraine and Chinese saber rattling, electoral politics here in the United States, all manner of things around the world to cause you anxiety. Yet when you look at equities as an asset class compared to bonds, they still have a very attractive return profile. So how can you get yourself comfortable to own those equities given this uncertainty? And that's where this portfolio that we manage for you can really be helpful. This is a portfolio we call low volatility equity. It is a global stock portfolio, long only, very simple in its structure. In terms of it just owns stocks, but what it does do is try to own the kind of stocks that will have less risk. And what we mean by less risk is they won't go up and down as much, and you can see this displayed in that bottom chart. When the markets go down, we expect to get around 70% of the markets down. So if a market were down 10, we would expect to be down only 7. We offset that with only being up about 90% as much as the market as when it goes up. So if the market were up 10, we would expect to be up about 9. Now, you put that together and the math is just in your favor that if you outperform during a down market, that counts for a lot and you can afford to give up a little bit when times are good. So as long as you're getting enough of the goods and you're protecting against the bads, this gets you to a higher rate of return with less risk over time. And that's exactly what we've been able to deliver. And you can see that on the right-hand side of the chart with strong absolute returns since the inception of the fund, which is over 10 years now, or just about 10 years now, and really best-in-class downside capture and Sharpe ratio. So we've been able to produce, and Sharpe ratio is just your amount of absolute return for your amount of absolute risk. So again, this is a portfolio that delivers on long-term performance, but by doing so, by lowering risk and creating a smoother ride. And why this is so important is that it's tough to hang in there in periods like today when the market is scary, when you see everybody losing money, when you're worried about your savings. It's hard to stay invested in those products. And when we can provide that protection, and good news is when you need it. And then the quote, bad news when we lag the market a little is when you're making a lot of money and things are good anyway. And so we designed this product specifically to help people stay invested in the asset class, stick with it through the ups and downs that are part of investing in the stock market, and still end up with a good outcome of outperformance and less risk. The approach we take on this is something that we call quality, stability, and price. And that is really how we go about selecting the securities that go into this portfolio. We want quality businesses with good business models and high profitability. We want stability in the form of companies that are not too economically sensitive, that don't move up and down with the economy or with interest rates or anything like that. And we want companies that are not too expensive, to stay away from some of those companies that get overvalued at times when there's a lot of popularity on a certain stock or sector. And so this balance of those three features, quality, stability, and price, has been our investment philosophy since we started the strategy in 2011, and continues to be how we go about facing today's market environment. And in fact, that's been allowed us to deliver the down market capture we talked about. And so you can see over the 10, I guess, or 8 largest down markets we've had about a 75% after fee market participation. So this is really providing us with that protection we talked about, getting less of the downside when markets are weak. You'll see that in this year's performance as well when I show that to you shortly. That quality, stability, and price is how we delivered on that. It's also how we are positioning the portfolio in light of the challenges we're facing today. We talked about those 3 challenges earlier. Slowing growth, we want to own companies that have stability. We want to own companies that, even if the economy is weaker, still have good businesses. So these are companies whose profits are stable in and out of economic cycles. Things like consumer staples and utilities, those are a big part of that part of the portfolio. Companies that have long-term relationships with their customers and therefore their revenues come back every year. Those kind of companies face a lot of this, form a lot of the stability in the portfolio. We want to be careful about price. As I mentioned, there's been a lot of stocks that got really expensive. You know what I'm talking about. Some of the tech and the disruptive names in the economy became very, very overpriced, and they've come back to earth. Well, we stayed away from those, and instead we're focusing more on the companies that are priced reasonably. And that has worked in our favor, as some of those companies have underperformed significantly in the last 6 or 12 months. And then on that inflation question we talked about before, we want companies that have that quality, that high profitability, that ability to pass this pricing pressure on, ability to maintain their profitability in light of this inflation. And so the main point here is those risks that I alluded to earlier in the conversation we're able to mitigate against them, to address those risks in exactly following our core investment philosophy of quality, stability, and price. And you'll see this again in the types of companies that we own on this next page. In that stability format, as I said, we want to own things like consumer staples. Keurig Dr. Pepper, this is a beverage company. We prefer beverages to food. And this is exactly the kind of company you expect us to own, a telecom company like HKT. We want to own companies that are reasonably valued and have good business models. McKesson is a drug distributor, and then is an insurance company. These are high quality, good businesses that are not all that expensive. They're just not that popular, to put it bluntly. And so we're able to buy the cash flows of those companies at attractive prices. And then we want to focus on those businesses that have quality, have the ability to pass pricing on, to weather an inflationary environment. Coca-Cola, a fantastic pricing power company, and one that really benefits as the world goes back to more normal and going out to eat in restaurants. It's much, much more profitable to sell a Coke in a restaurant than it is in the grocery store. ADP, this is one of those companies I talked about with the recurring revenues, the consistent contracts. They're a human resources and payroll outsourcing company. Once they are embedded into your business, very, very difficult to dislodge. Nobody wants to change their payments company, and so it stays in there. And so this has very consistent profitability, and as they offer more and more services to their customers, they're able to increase their revenue per customer as well. So by sticking to our knitting, sticking to what we told you we would do, we're able to deliver and position the portfolio appropriately for today's risks that we see in the market. And one of those risks we talked about is inflation. And this is the last point on sort of our philosophy I want to make. We as a team focus on microeconomic and company level research. Try to understand what a company is doing, its strategy, and whether or not that will be successful and produce good earnings. We are aware that inflation and recession are huge risks today. We talked about them earlier and all the different mixed signals on this. But we know we're not smart enough to predict it exactly. That's not where our strength lay. So instead, when we're faced with something that's a large risk in the market, we work to try to neutralize it, to build something that can work in any kind of environment. If inflation turns out to be worse than everybody expects, a company like Visa will benefit from that, because the $100 you charged on your card yesterday is now $110, and they collect a larger fee. So they're a natural hedge against inflation. On the other side, if we have a recession that offsets this, as they get rid of this inflation, then we're going to want things that are super defensive. That's something like pharmaceuticals, defense companies. Those are the types of companies that will work on the other side if the other scenario comes true. So again, we want to be balanced with the core of the portfolio then in high quality, consistent compounding companies that produce profits in any kind of market, and Microsoft is a perfect example of that. So again, rather than trying to think we're clever enough to pick what's going to happen, we just identify this is the big risk now. Let's make sure we're positioned no matter what happens to deliver on performance for our clients. And that's exactly how we go about doing it. So from a positioning standpoint, we own a lot of the things you'd expect. We're overweight in staples and telecom and the like, but we're also able to find companies in other sectors that might be less obvious. Technology. It's not the super high tech. It's not the high flying stuff that's very expensive and exciting. It tends to be enterprise technology like we talked about, like Microsoft, companies that serve banks, telecommunications companies, and others, companies that produce the back office software that makes corporations run. These are really stable, consistent businesses, and those are the types of things we like. And then on the other side, we're underweight the more cyclical parts of the economy. We're underweight energy, we're underweight discretionary stocks, we're underweight industrials and materials. These are all the more cyclical parts of the economy, and that's generally where we're underweight. Those don't carry that stability characteristic we look for. They tend to be more volatile, so we'll have less of those. So again, the positioning of the portfolio is exactly as you would expect, with the characteristics you would expect. Overweight the parts of the economy where they're more QSP, quality, stability, and price, and underweight those parts that are more volatile. And you can see this finally in exactly how we're positioned from a characteristics in the portfolio. And this, you will always see characteristics like this: higher quality. We measure that by return on assets. How much profit does the company make with in comparison to the amount of assets invested? You see that we're more profitable than the market as a whole. Stability, here measured as beta, or the sensitivity of the portfolio to the market. One means you have the same risk as the market. We have a 0.82 beta. We have 82% of the risk of the market. So we're able to lower that risk, just as we talked about, protect on that downside, offer you more stable and consistent, a smoother ride across inevitable ups and downs. And then on the price side, we're always going to be cheaper than the market. We measure that in the price to the free cash flow that the company generates, and you'll see we're about 2.5 multiple points cheaper than the market on that measure. Again, consistent approach of quality, stability, and price. What does it really mean? We buy a lot of boring companies. That's okay. We buy a lot of consistent, stable, steady companies that deliver their earnings in and out of different market environments. And by doing that, we're able to produce the performance we showed you before on the down market protection, even after fees, giving you only 3/4 of the market's down when it goes down. And if we take a look at how we've been doing this year to date, here on the left-hand side, you see the market's been down just over 20%, and we've been down 14. So we're 6% better than the market. Again, right about on that 70% down market capture for the year to date. Second quarter, same thing. When the market really fell off, we were able to deliver on that good performance and outperform significantly in that environment. That's what we're meant to do, to deliver on things, to give you that good performance. And if you go all the way over to the right and you look at the performance since inception, we've been able to beat the market, and this is after fees here. We've been able to beat the market with less risk. And if we can do that, we've been able to beat the market with less risk by about 0.5%. You see the risk over there. And when you compare it to sort of other low risk portfolios out there, and we just show you the minimum volatility portfolio as another example, we've been able to beat that significantly as well. So we provide you with the down market protection, the less risk that you're looking for, but better absolute returns. And that's exactly what we target for our customers. That's so with that, I want to turn it over. These are the performance numbers just in rolling periods, showing you very much the same thing. With that, I'll turn it over to our presenter for any questions that people may have.
I will start with two questions. What are the challenges that investors face today, and are we going, or are we in a recession?
Right. So as we talked about, I think the big challenges are the uncertainty in the market today, and the inflation that we're facing, and whether or not that pushes us into a recession. There's a lot of argument about whether we technically are in a recession in the United States, and we had 2 quarters of very modest economic contraction. So I guess on some measures we are. It doesn't matter. If you go from growing fast to growing much more slowly or negative, it feels like a recession. It feels like a slowdown. It puts pressure on people. And I think we're going to have to wait and see how this plays out. But unfortunately, the history is that when inflation gets this high, you need to, in order to stop it, you push the economy into a recession. Now, we can hope that we don't, and as I showed you, there's some data there around household balance sheets and savings and the like that offer some hope, but it feels like we're heading towards at least a modest recession.
Okay, thank you. And now, how should we expect stock behave in this environment?
We would anticipate that we will continue to see high degree of volatility in the market as everybody wrestles with this. Are we, aren't we? How bad is inflation? How much is the Fed or other central banks going to have to act? How stable is China is an increasing question on everybody's mind. All of this creates uncertainty, and I think we have to expect markets to be volatile. That said, corporates are in good shape, profits are really strong, and interest rates are really low. So stocks still look attractive versus the alternatives. And so we think you want to be part of the stock market, you want to own equities, but you've got to be prepared for it being a bit of a rougher ride than we've been in the last 6, 8, 10 years. That's why we have a portfolio like this to help smooth that out.
Okay, and how can global low volatility helps investors in these uncertain times?
Yeah, it's exactly that. By buying lower risk companies, by buying those stable kind of companies that can produce earnings inside and out of different market environments, we can get you that return premium that comes from owning equities, but do so with less risk so that you and your clients can hang on when times are scary, because everybody wants to do, and we all know this about ourselves, times get tough and then you want to sell, and it's the worst thing you can do is to sell after something's gone down. We all know this intellectually, but we're all emotional creatures, and when you're faced with that uncertainty, and especially after the market's gone down, there is such a temptation to sell and buy back in again after it's already gone up, and that's the exact opposite of what you need to do. So if we can produce a portfolio that can limit those downs, help people stick in the market through the cycle, you can achieve those higher returns over time by staying as a participant.
Okay, I have two about the portfolio. How the portfolio is responding to today's environment, and how is the portfolio positioned right now?
So we're very balanced across different types of sectors, as I think I indicated. Overweight the more safe parts of the economy, the more stable parts of the economy, the defensive parts of the economy. Underweight the more cyclical parts of the economy. Underweight energy and materials, industrials, consumer discretionary, the things that have the most volatility and most exposure to economic slowdown. But doing that in such a way that we are conscious of price and don't overpay for it.
Okay, and the last one, how the portfolio done in this environment?
So far we've been delivering on exactly what we told customers we would do. We've protected as the market has sold off, and protected just about right on that 70% down market capture I mentioned. I would just say to you, we're not that smart to have foreseen what happened this year. We're not changing things. We didn't do a lot to the portfolio. It's just the way we're positioned. That balance of quality, stability, and price that I've mentioned throughout my talk positions us well for this type of environment. This is what we're built for, is saving people money and anxiety when markets are weak. And we're very proud to be able to produce numbers like we have so far this year that have done exactly that for our customers.
Muchas gracias, Christopher. Ha sido un privilegio escuchar tus apreciaciones ante lo que podemos esperar en este contexto de alta incertidumbre. El modelo de negocio de Mercado de Valores tiene como prioridad usted y ofrecerle una asesoría personalizada enfocada en el análisis constante y el seguimiento y el cumplimiento de sus objetivos de inversión. Gracias por unirse a nuestras jornadas patrimoniales Visión 360 y los esperamos en el siguiente espacio exclusivo para usted.